Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. At the time of this recording, the S&P 500 is down 16.3% year to date. Just a few weeks prior to that, it was down over 20%. A bear market is usually defined as a stock market decline of 20% or more. Since we were technically just in a bear market, I think that this video is an important one to make. The reason for that is because new investors could easily get spooked seeing their $1,000 turn into $800 or their $10,000 turn into $8,000 since the beginning of the year. In this video, we're going to talk about how to invest in a bear market and more importantly, how wealthy people invest in a bear market. Stay tuned. If you're under 30 years old, you have no idea what a bear market is. Yes, we were technically in one. Yes, we did have the crash from cerveza sickness in March of 2020, but none of you young bucks have truly seen a painful recession or prolonged bear market in your investing lifetimes. As I've mentioned over the 5 years that I've been on YouTube, low interest rates, cheap debt, and unprecedented money printing have made everybody think that they're the love child of Warren Buffett and Peter Lynch. Newsflash, you're not. So why am I starting the video off like this with this rant? Because a lot of you have learned a lot of bad investing habits over the past 14 years of easy money, especially over the past 2 or 3. So what do I mean by this? I mean, a lot of you have forgotten to maintain a holistic overview of your financial health and perspective and have gotten used to number goes up. Instead, you're getting enticed by the next meme coin or the next meme stock that will 500x your portfolio overnight. Yeah, right. Investing is a get-rich-slow game, and to play the long game, you need to have a strategy in place that you will stick to and not waver every time market sentiment changes. This video is going to boil down to essentially 3 things: big picture investing, diversifying your portfolio with alternative investments and classic investments, and having a long-term plan and sticking to it. This sounds so easy in practice, but not easy when you see your net worth dropping by 30 to 50% like many did in 2008. There have been 26 declines of 20% or more in the S&P 500 between 1929 and 2021, and they lasted 289 days on average, according to Ned Davis research found on Investopedia.com. The reason I'm telling you this is because 289 days is pretty long. This gives you plenty of time to take a breath and figure out how you want to deploy your money, if at all. So with this being said, let's get into step number 1. Okay, step number 1 is big picture investing. Okay, this is how the wealthy invest. So big picture investing is basically, when in doubt, zoom out. I have always been a big proponent of having a diversified portfolio, not just in stocks, but also in alternative assets as well. You want to diversify across asset classes, not just different sectors of stocks. So instead of, energy, tech, growth, small cap value, whatever, you want to be in completely different asset classes. So equities, bonds, real estate, which we'll touch on later here. So some people call this diversification. Other people call it diversification. If you have a specific plan that works for you, don't change it. However, the way that my wife and I look at our total net worth is just like a pie, with each slice of the pie being a different asset class, and each asset class has a different weighting, okay? It's a smaller or bigger slice of our overall net worth. So this is why I don't worry when bear markets come around, because I've diversified our net worth to the best of my ability. The reason that I'm a fan of having a diversified portfolio across many different asset classes is because it typically reduces volatility within a portfolio. Let's take a look at some of these asset classes and figure out if they can be a part of your portfolio as well. Okay, so if you're watching this on a phone, this may be a little bit small. Maybe you're watching on a tablet or on your TV, but flip your phone sideways so you can make the screen as big as possible. So number 1 is cash. Cash is both offense and defense. So wealthy people, they always keep a little bit of cash, not only as an emergency fund, but they also keep it as an opportunity fund or a war chest. So when an opportunity comes during a bear market, you can scoop up assets when they're on sale. I hate that phrase, stocks are on sale. Like that's the corniest phrase ever. Don't look at it like that. You just need to look at finding the mean value of what you're buying in. And that way over time, the number will hopefully go up and to the right. Again, zoom out. So number 2 is stocks. These are equities. Typically, dividends and growth are a good way to mix. So if you've had the funny money printing and you've been successful over the past 10 to 14 years because of that, growth has absolutely crushed everything. However, now that we're in a bear market, typically dividends tend to outperform as well as value stocks. So you may want to have a small combination of all of those. Number 3 are bonds, specifically I bonds in this case, especially in a high inflationary environment. These can actually be used as part of your emergency chest or emergency fund. Just in a very, very small nutshell, these are designed to actually keep up with inflation. So when you see CPI coming back at 9, 10, 11%, that's basically what these are based off of, is whatever the CPI print is. So these can be used as a way to at least keep you from being a loser if you are a saver when it comes to inflation eating away your purchasing power. Number 4 is real estate. This is tried and true. In a lot of countries where people don't have 401ks or Roth IRAs or all the things that, first world countries may have when it comes to pensions and retirement plans, families have typically preserved their wealth using real estate, and real estate actually is considered an alternative asset class. If you don't have enough money to invest in physical real estate or commercial real estate, you may want to look into either syndications, or you can even look into platforms such as Fundrise, for example, which you can invest in actual tangible real estate, just doing it through a third party. The fifth one, is PM, that stands for precious metals. These are typical gold and silver bars, physical bullion. I'm not talking about a gold ETF. I'm not talking about gold paper. I'm not talking about any of that stuff. I'm talking about the actual physical bullion. Number 6 is Bitcoin. Notice how I say Bitcoin and not crypto. 99% of crypto is garbage, which I've been saying for about 3 to 4 years now. Once you understand money, once you understand how Bitcoin works, it's basically digital gold. It replicates gold's properties, but for a use case in the 21st century. If you don't know anything about Bitcoin, please don't leave an ignorant comment in the comment section below. You're basically going to be telling the whole world that you don't understand how money works or how Bitcoin works. If you want to understand how Bitcoin works, I suggest you read the Bitcoin Standard, Inventing Bitcoin, and also the Bullish Case for Bitcoin. Once you read those 3 books, then you can form an opinion on your own. Number 7 is land. A lot of people don't talk about land as an alternative investment. Land is great because you can develop it, you can grow things on it, you can use it for investment purposes, you can use it to preserve wealth if it's going to be in the path of progress, meaning that jobs are going that way, homes are being built that way, infrastructure is being built that way, highways, schools, things like that. As long as you hold land in an area where the population is rising, or if you're going to use it to grow things, land is a great investment for the most part. And then finally, we're going to talk about collectibles such as cars or artwork and other niche categories that you may know about that other people don't. Cars, if you look at Porsches over the past 3 years, they've exploded in value. If you look at, classic cars, if you look at artwork, if you look at things like that, those have all done very, very well. If you know about a niche that other people don't know about, leave a comment down below if you want to share some of your high ROI niches that others may not know about. My dad and I, we just sold a 2005 Carrera S. We bought it in the low 40s, sold it in the low 50s, held it for, I think, about 4 years. In that same time, the S&P 500 gained like 12%. The Porsche gained like 12%. I can post the actual numbers on the screen here. So if you have any other high ROI niches down below that others don't know about, if you want to share it, go ahead. If you're interested in investing in shares of artwork, here's a word from today's sponsor, MASTERWORKS. Where to invest is a question on everyone's mind right now. After all, there have been days this year where 99% of stocks have lost value. Of course, any single day doesn't make the market, and stocks are long-term investments. But we're all thinking, hey, I'm diversified. Why is my portfolio still getting wrecked? Well, Goldman Sachs has released a shocking report saying the classic stock bond strategy won't be enough to keep investors afloat. It's actually down 34% this year alone, its worst performance in literally a century, as you can see from this graph right here. As a result, Goldman says the ideal allocation for stocks has shrunk from 60% to around 45%. So what do they recommend you do with that difference in order to salvage some of your returns? Invest in real assets like fine art. I know it's surprising, but Goldman Sachs says fine art can protect your purchasing power even in the face of rising prices. The last time inflation was this high, it appreciated an incredible 17.5% per year on average. The MASTERWORKS platform qualifies their paintings with the SEC, turning legendary art into an actual investment for a fraction of the full price. They've had a total of 8 exits, with 5 of them this year alone. MASTERWORKS' last 3 exits delivered 17, 21, and 33% net returns. One of those was literally a few weeks ago for a 17.8% net. As a result, MASTERWORKS has had to acquire and release more art on its platform to meet demand, and there is a wait list. But you can skip this wait list by clicking the link in the description and signing up for MASTERWORKS today. Okay, thank you for sitting through that ad spot. This is how I pay the bills and provide all of this content for free. The next part of this video is more philosophical than tactical. So what do I mean by this? The next part of this video is having a long-term plan and sticking to it. You need to stay the course and trust the process and understand why you're investing in the first place. Okay, why did you even start doing this? Because if you don't understand this, you're going to panic and hit the sell button the second your portfolio is down more than 10%. Every successful investor that I know typically sticks with what they do best during bear markets rather than tinkering with their portfolio. So stick with your bread and butter. If your bread and butter comes from your W-2 income from your job, then I would do everything in my power to make myself indispensable to my company or work on my business so that I can weather the storm. While you're still generating income from your W-2 or from your business, I would dollar cost average into the bear market so that when things do come back up, again, zoom out, not only were you buying assets at a discount, you stayed the course the entire time and didn't make drastic decisions. I can't stress this enough. Don't do anything drastic and do not panic. Don't do anything different than what you were doing in the first place when it comes to investing. The market rewards patience. This is where I can see having a coach or financial advisor could provide the most benefit to a retail investor who may get spooked at the first sign of a bear market. I remember when I was still doing consulting calls, someone called me in April of 2020 after the huge dip in the market, and they asked me if they should sell all of their stocks and liquidate it into cash. I told them that that was absolutely a stupid idea, but I was also continuing to keep dollar cost averaging into the market myself. A few months later, the market hit new all-time highs. If that person would have sold at a 20 or 30% loss and missed out on all the new all-time highs, they would have lost a ton of money just because they panicked and they weren't patient. The stock market has averaged close to 10% per year over the last 50 years. Remember, when in doubt, zoom out. Okay, and as always, I'm going to leave you with my thoughts at the end of the video. So 3 very quick points. Bear markets will test you. Again, what I just finished talking about was how this kid called me, said, hey, should I sell? I'm down 20, 30%. I said, absolutely not. I just told him exactly what I was doing. I'm gonna keep dollar cost averaging. Bear markets are going to test you. When you log into your Schwab account and see that your 100 grand is turned into 60, you're gonna say, holy crap, I'm pulling this out before I lose any more. Well, all you have to do is zoom out, just go onto Google, type in S&P 500 chart, hit lifetime or max, and see what it's done over time. You will be rewarded for your patience, trust me. Number 2 is diversify assets. Again, not looking at different sectors of equities or sectors of real estate or sectors of one thing. Diversify asset classes. If you're not a professional investor and you're not laser focused on something like real estate or laser focused on trading a certain sector of stocks or laser focused on whatever, it's going to behoove you to be diversified. If you have a day job, if you run a business, if your bread and butter is something else other than being a professional investor, diversification will benefit you in the long run and will help you sleep better at night because it reduces volatility. And then number 3, as long as the dollar is strong, you're good, okay? What do I mean by this? Oil is traded in dollars. This is the petrodollar. We're the world's reserve currency. The United States' biggest export is dollars, okay? So as long as other countries still have demand for dollars and our economy is still doing well based on this fact, you're gonna be fine. Is that gonna be the case 100 years from now? I have no idea, okay? 100 years from now, we may all be speaking Chinese, right? So you see other countries like the BRICS, Brazil, Russia, India, China, South Africa, they're starting to get away from the dollar because of this exact reason. It's too strong. So in our lifetimes, we're gonna be good. However, if you start to see little things crack away, like let's say petrodollar goes away, let's say something else becomes the global reserve currency, which in our lifetimes most likely won't happen, this is when you should start worrying about other things than just your portfolio. So as always, I hope you got value out of this video. Please hit the like button, please share the video. This channel has 915,000 subscribers. My last video got like 10,000 views, okay? So, I don't wanna do the flame thumbnails. I don't wanna do the clickbait. I'm too old for that. I don't wanna do it, but it does work. So part of me is like, do I just do it? Part of me is like, that's not me, who I am as a person. I don't know. It's kind of a pickle. You know, you don't hate the player, hate the game. Don't hate, you know, the people doing the thumbnails and the titles that are obviously inflammatory and clickbait. You know, hate that the algorithm promotes that kind of stuff. And also you should hate yourself for being dumb enough to watch those kinds of videos and click on them, telling the algorithm, hey, more of these flames and rocket ships, right? So I'm just playing. At the end of the day, share the videos. These are all free. That's why I take some of these sponsors like MASTERWORKS, like Policy Genius. It's just a way for me to continue paying myself and making this content for free. So as always, thank you so much. Have a prosperous day. Hey, yeah, I just finished the sponsored video. Oh, okay. Oh, everyone lost their money? Oh, it's okay. I just virtue signaled on social media and now I can sleep at night. Oh, okay. Yeah, I just made a tweet. I made it sound like I cared. Okay. Yeah, I'll meet you later. I just gotta stop at the bank real quick. Okay, thanks.